Wow. But now you can go to Yahoo Finance, Google Finance, MSN Money. MSN Money is my favorite place, money.com. Just money.com. You have online brokers and rating services like TD Ameritrade, E-Trade, Scottrade. Zacks is a rating company. Morningstar, another rating company. Moody's. Zacks and Morningstar we'll talk a lot about this semester because they're really useful to us. Information is instantly available to everyone. Well, I should say data is instantly available. We have to work hard to turn it into actionable, make it actionable, and then it becomes information. So what are we going to talk about this semester? We're going to talk about the market. I will call the market Mr. Market. We'll talk about Warren Buffett and Benjamin Graham, his professor. Professors are valuable, you know, sometimes. Talk about the myths of investing, rule number 1 in the 4 M's. We'll talk about the difference between a stock and a business. Intrinsic value and sticker price. This is the main technical challenge for us, is to estimate the true value of a stock, recognizing that the efficient market theory says that all information that could be known about a particular business is known instantly at all time. And so therefore, the market price is the true value. That is unadulterated hogwash. That is total baloney. Market price and value are two very distinct things. And so our investing is kind of like trading mules. You buy cheap, you sell high. And what you try to do is to figure out what the true value of the stock is, the business is, and buy way below it, and then sell it when it gets close to the true value. And you just do that over and over and get rich. So we're going to talk about it, how to compute intrinsic value. We need to know when to sell and when to buy. Tools to help us buy and sell. Technical analysis is what we'll call it, what we use. And then we need to develop a plan for building wealth. What part of our life are we going to make this investing? How much time are we going to spend with it? We're going to talk about the difference between investing and trading. Now, I've already confessed that I'm a trader. Okay. Investors have a different time horizon, particularly value investors, and that's what we're going to talk about, is value investing. So we're looking at making a profit, say, on the average, maybe several years down the road, whereas traders are trying to make a profit today, maybe this hour. There are all kinds of traders. You have high-frequency traders, algorithmic traders. Algorithmic traders provide fluidity and provide liquidity in the market. We have one of the biggest high-frequency traders is a company over here in Kansas City. And they use computer algorithms to buy and sell. They might, in any particular 5 or 10 minute period, they might be selling millions of shares of 1,000 different stocks, buying and selling, according to a computer program. It provides fluidity in the market, it provides liquidity. You need volume, you need traders in the market in order for the market to work. When the liquidity of the market diminishes, strange things happen. That's why I tell all my students, don't buy and sell in the first 30 minutes of the day and the last 30 minutes of the day. That's for the big boys. Who are the big boys? They're the mutual fund managers, the institutional traders, the big banks. You don't want to fool with them because they'll have you for lunch, and it is a competition. They'll be trading millions of shares of Apple or of IBM, and you might be trying to sell or buy a couple of shares. You don't want to get in their way. It's like a huge ocean liner. They just run over you. So stay away. Don't buy and sell. Actually, I think the first hour and the last hour of the day. In Rolla, the market opens at 8:30 in the morning and closes at 3. And so This course is about investing, not about trading. I will say things about trading because I'm a trader. I can't help it. You know, I just, you know, for instance, when the market's down, market's way down, you'll see I want to get class over with so I can go to the office because I'm buying like crazy when the market's down. See? When the market's real up, I usually want to get finished too because I'm selling like crazy, you know. So investors have a longer time horizon. You can be an aggressive or a conservative trader. It depends on your personality. Have all of you taken the Myers-Briggs personality type indicator? Do you know what your personality is? Do you know if you're aggressive or conservative? Well, anyway, if you haven't taken the Myers-Briggs, you should. And learn about your personality. Are you an aggressive type person? Are you a type A? I look around the room and I see a lot of type A's. So we need to put a throttle on these type A folks, like me. Diversification and risk management. Efficient market theory says that you have to own a minimum of 200 stocks to diversify risk. That's total hogwash. Total baloney. Garbage. And the reason it's garbage is it makes your stockbroker rich. He makes all his money when you buy. He doesn't make any money when you sell. So he wants you to buy a lot. So every time you talk to him, you say, well, I've got this really good deal over here. One of the things I'll convince you to do is to get away from the broker. Do your own thing. Be responsible for your own investing. The other thing I will tell you is forget mutual funds. Mutual funds, as a general rule, are the world's biggest ripoff. The guy that's making all the money is the manager, and he's down in Jamaica, you know, at most of the 10 months out of the year, and he doesn't give a damn about your portfolio. All he cares about is if he beats the S&P 500. So if the S&P 500 is down 17% and he's only down 15%, he says he won. I said, wait a minute, my account's smaller. So forget mutual funds. We're not going to do that. Are you aggressive or conservative? This approach to investing is conservative, but that doesn't change who you are. So if you're a type A personality, you're going to have to really discipline yourself in order for this to work for you. This will work if you apply it correctly. But it's like anything else, like a car or a gun. You know, either of them can result in death. And the car or the gun is not inherently bad, it's how they're used. You got it? Same way with investing. It's how it's used. Oh, I tried that once and I went broke. Well, you're an idiot. I wasn't able to save you from you. We're going to diversify, but we're going to do it in a very different way. We're only going to own 5 or 10 stocks at a time. And we're going to diversify amongst sectors. But we're only going to buy the best one in the sector. And we're going to find out how to select the best one. Okay? Whereas traditional investing using efficient market theory says you got to buy 200. You got to at least 200. 1,000 would be better. Well, who has the time for that? So we call this approach value investing. Mr. Market. Now, Mr. Market is bipolar. Everybody know what bipolar disease is? You have to take lithium, you know, to moderate your brain chemistry. Mr. Market is bipolar. And occasionally that bugger goes off his meds. And he just acts really nuts. You know, value and price gets highly separated. In other words, when Mr. Market is off his meds, IBM's price is tremendously higher or tremendously lower than its value. Well, we take advantage of either way. Doesn't matter. So we're happy that Mr. Market is bipolar. We're not sad. I mean, I hope the fellow would take his meds and things would be calm, but he won't. What's the difference between So you need, one of the premises of this course, and one of the real realities of life, and I want you to put this in your brain, never to be forgotten: price and value are not the same. If they were the same, we couldn't make money in the market, and I can assure you we can make money in the market. Price and value are not the same. What's the difference between the institutional investor, you and me? I call the institutional investor big boys. These are guys and gals that are selling millions of shares, buying millions of shares, and they're doing it all the time. They have to disguise what they're doing. They have algorithms. They decide they want to get out of Apple. Apple hits 420. It hit 422 this week. I sold a big lump of shares at 405 because I bought them at 86. You can figure that out for yourself. But I still have a big lump, and I've got to order in to sell a bunch more at 450. Now, but, you know, a bunch for me is 100. For these guys, it's 1 million or 10 million. Now, what they have to do, see, when you put in an order to sell 1 million shares of one of those stocks you're selling, what happens? You know, the market is an auction. It's like, I don't know if you've ever bought cattle or horses. You go to the auction. It's what the buying and selling pressure is what determines the price. And so if you put in an order to sell 10 million shares of IBM, what's going to happen to the market price of IBM? It's going to go down. It's going to go in the tank. So they have algorithms to disguise what they're doing. So they'll sell their 10 million shares over 3 weeks. And they'll sell them at particular times of the day. They have a computer program so that over that time, they're 10 million shares. So we have to figure out what they're up to. So we don't go ask them. We don't care what they say. We just look at the market. So we use technical analysis to see what they're doing. And it's very accurate. The data doesn't lie. And you need to realize that we're not an institutional investor. No matter how much, you could have several million in your account, and you're not going to be like them. I mean, you can't imagine how much money they got, okay? Now, efficient market theory, we're going to talk a lot about it. And now, this is a course in the, we have a financial engineering program, and I know about efficient market theory, and it's important, and I use it, as a matter of fact. You just have to realize that it's just a theory. You know what I mean? It's just a theory. Is that we've had, what, 50 years debate in America about evolution and creation. And they're both theories. Educated people, you ought to be able to discuss them both, but we can't seem to be mature enough to do that, you know? Well, I hope we're mature enough in investing to realize that this is a theory. And we want to use parts of it that seem to work, and we want to reject the parts that don't work. The big part that doesn't work is that price is not equal to value. Intelligent investor. Oh, boy. And who sets the price? Institutional investors, they set the price, not you and me. They control market price by their behavior. And you and I don't do it. We don't have enough shares to do that. We don't want to. We want to take advantage of this inequity between price and value. Okay, let's look at the market. How much time have I got? I got another 15 minutes. I need another 2 hours. Okay. Most investors own mutual funds and diversify to decrease risk. I want you to get rid of all your mutual funds just as soon as it's convenient, because they're just a big drain on your profitability. Look at the Dow. You know what the Dow Jones Index is? That's just 30 blue chip large cap stocks. You know what capitalization means. You know what large cap is. Capitalization, you compute the capitalization for a company, take the current price of the stock, multiply it by the number of outstanding shares, and that's the capitalization. So we take the top 30, called the blue chips. For instance, in that is Alcoa, General Motors used to be. I'm not sure if the new GM's in the Dow or not. I don't think it is. But you can go online and just Google Dow Jones Index, and they give you the 30 companies. I'm sure I've got it in my slide somewhere. Okay, so we just look at the Dow. It's an index. In 1906, it was 100. That's when it started, and that was the basis. They normalized all the prices to be 100. 1942, it was 100. So if you'd have bought the Dow, all 30 of those companies, and held them for 35 years, what would you have made? Goose egg. 0. 1965, it was 1,000. It's up 11% in 22 years. 1983, still 1,000. 0 rate of gain in 18 years. 2000, it was 11,000. 15% in 17 years. So the Dow is, it's just how those stocks did, but the market is not, it's somewhat erratic. Here's what the Dow Jones looks like over from 1900 more or less up to, I think that goes up to February of 2008, something like that. Now, one of the, see this, how do I, here we go. What's this? This is a crash. And so you got to be, you know, you like this, boy, this is great, but you don't like that. Okay, so we got to be able to sense that. Okay, S&P 500. This is just a broader index, and it has small caps, medium caps, large caps. It's supposed to be more representative of the market. It's a surrogate of the market. It's trying to answer the question, what's the market doing? And so there are 500 stocks there. And one of the things I've found is the S&P 500 and the Dow, they're more correlated than these organizations would like to admit. And so this is how it's gone over that same period. The market in mutual funds soared from 1980 through 2000. But Mr. Market is a cruel taskmaster. Since 1984, only about 4% of funds have beaten the market, S&P 500. In 2011, the word's still out, they haven't published, but I bet the result is no mutual fund beat the market in 2011. I think none of them did. Now, this was from an article in Forbes magazine. It's kind of interesting. They hired, in Fortune magazine, they hired a monkey, just set him in front of a console and just let him punch, and he traded stocks. And he beat he beat the best fund managers. Okay, Warren Buffett, CEO of Berkshire Hathaway. We'll pay a lot of attention to Buffett. Now, I want you to go tonight. Two things I want you to do tonight. I want you to sign up for that TD Ameritrade deal to open your account. Won't cost you anything. And then go to the Berkshire Hathaway. There's how it's spelled right there. There's how it's spelled, Berkshire Hathaway. Go to their webpage. And he's got all of his annual reports there. Read the latest one. It's very edifying. Okay? Currently, one of the richest men, he and Bill Gates, and then the fellow down in Mexico, what's his name? What is it? No, not the drug dealers. The legal guy. I can't remember his name right now, but anyway, the three of them compete each year. Made his what is it? That's him. That's right. Made his fortune through wise long-term investments. He's a billionaire many times over. Takes a salary of $100,000. His board of directors pushed him into buying a Cadillac a few years back because he just drove Ford back and forth to work. In Omaha, you can go to the annual meeting up here in Omaha and you can have dinner with him. A student of Benjamin Graham at Columbia University. Berkshire Hathaway. Okay, if we had invested $10,000 in Berkshire Hathaway in 1965, how much were we? Well, actually about $58 million now. About 23% average annual return. Why didn't we do that? What's wrong with us? Why didn't we do that? There's Class A and Class B stock. I've owned them both, and when Class B stock, for many, many years, he wouldn't split the stock and he wouldn't pay a dividend. And when he bought Burlington Northern, he bought a railroad. the whole thing. In order for that to work, the SEC required him to split the B stock, which was selling about $4,400 a share, and so he did a 50-to-1 split. So all of a sudden, I had a whole bunch of Class B stocks. They own entire companies like Geico, Clayton Homes out here, and Burlington Northern. These they take off the market. They own Dairy Queen. So if you go to the annual meeting, you get dilly bars for free. They own they're the largest shareholder. This is a big attraction for me, dilly bar. Coke, American Express, and about 50 other, they own about 50 companies, and he invests in about 50. And Warren Buffett himself personally is a trader, and he does a lot of options trading. Other winners. Now, I've given you one for each decade. Here in the 70s, if you'd invested in Walmart in 1970 when it went public, that'd be worth $10,000 you invested. It'd be worth $47 million today. If you'd have put $10,000 in Southwest Airlines in 1980 when they went public, it'd be worth $500,000. If you put $10,000 in Dell in 1990 when they went public, it would be worth $4.2 million today. Now, why am I giving you these examples? It can be done. It can be. The question is finding out which ones to buy and when to buy them. Okay. Benjamin Graham, the Dean of Wall Street, lost everything in the crash of '29. He had built up quite a lot of wealth, and then he lost it all, as most investors did. Most of them jumped off buildings, died. They couldn't take the depression associated with no money. And